Imagine this. You put $500 into a single trade. The next morning you wake up, check your phone, and that $500 has turned into $15,000. Sounds like a dream, right? Well, for some crypto traders, that dream actually became reality. Stories of ordinary people flipping small amounts of money into millions within days are everywhere. But here's the brutal truth: for every one person who strikes gold, hundreds lose it all. Some even wipe out their life savings in just a few minutes. And that's because trading crypto isn't like trading stocks, Forex, or gold. It's a completely different beast.
That's why in today's video, I'm going to break down everything you need to know about trading crypto, from absolute zero to the strategies pros actually use. By the end of this video, you'll have a roadmap. You'll know not just how trading works, but also the mindset and tools you need to actually survive and thrive in the most volatile market on earth.
EMA Clarence, and let's dive right in.
Step 1. Why crypto trading can be so profitable. So, why do people even risk trading crypto when the chances of losing money are so high? One word: volatility. Crypto is the most volatile financial market in existence. That means prices can skyrocket or crash by 10%, 20%, even 30% in a single day. Let's put that into perspective. In the stock market, a 5% move in a single day is considered huge news. In crypto, a 5% move can happen in 5 minutes, sometimes in seconds. And where there's volatility, there's opportunity. Think of volatility like a wave. If you know how to surf, you can ride that wave to incredible heights. But if you're unprepared, that same wave will wipe you out. Step 2. The emotional game. Here's where most traders fail: emotions. When the price of Bitcoin, Ethereum, or some altcoin suddenly pumps 15% in an hour, what happens? People feel greed. They jump in because they don't want to miss out. When prices dump 20% in a day, people feel fear. They panic and sell to save what's left. This cycle of greed and fear is what drives almost every market movement. Now, here's the wild part: this isn't a new discovery. Back in the 1700s, a Japanese rice merchant named Hama Munehisa figured this out. He studied the emotions of traders, noticed repetitive patterns in price movements, and invented the candlestick chart, the same charts traders use today in crypto exchanges. So every time you see a candlestick pattern like a doji, a hammer, or an engulfing candle, you're basically looking at a picture of human emotions, fear, and greed frozen in time. Step 3. The harsh reality. Now, let's be real for a second. In theory, trading seems like a cheat code for wealth. In practice, most people fail. Here's why. 1. They trade without a strategy. 2. They risk too much money at once. 3. They let emotions control them. 4. They chase hype and signals from random people on social media. And in crypto, those mistakes are 10 times deadlier because of the insane volatility. Think about it. If you put $1,000 into a stock trade and it goes against you by 5%, you lose $50. Painful, but survivable. In crypto, that same $1,000 can be wiped down to $100 in hours if you don't use risk management. That's why so many beginners burn out fast. They come in chasing fast money and leave broke, blaming crypto instead of their approach. Step 4. The basics you must know before trading. So, if you're starting from square one, what do you actually need to understand before pressing buy or sell? Here are the fundamentals. 1. Exchanges: platforms like Binance, Bybit, Coinbase, or KuCoin, where you buy and sell crypto. 2. Trading pairs. You're not just trading Bitcoin, you're trading it against something else like USDT, Tether. Example, BTC/USDT. 3. Candlesticks. Each candlestick represents price action in a specific time frame. Green means buyers dominated, red means sellers won. 4. Support and resistance. Think of support like the floor price struggles to break below, and resistance like the ceiling price struggles to break above. 5. Leverage. This allows you to trade with borrowed money. Sounds powerful, but it's the quickest way to get liquidated if you don't know what you're doing. 6. Risk management. Setting stop losses, limiting how much you risk per trade. Pros recommend 1 to 2% of your account. Without these basics, trading is like jumping into a boxing match blindfolded. You won't last long. Step 5: Why emotions are predictable. Here's the cool thing. Because human emotions don't change, market movements follow predictable patterns. When everyone is euphoric and shouting to the moon on Twitter, that's usually the top. When everyone is crying crypto is dead on the news, that's usually the bottom.
The trick is to stay calm while others lose their heads. Remember the old saying, be fearful when others are greedy, and greedy when others are fearful. Easier said than done, of course, but that's the skill that separates winners from losers.
Step 6: Different types of crypto trading. Not all trading is the same. Here are the main styles. 1. Day trading, opening and closing trades within a day. High stress, high activity. For example, binary trading like pocket option. 2. Swing trading, holding trades for days or weeks, waiting for bigger price moves. For example, Degen trading. 3. Scalping, super short-term trades, sometimes seconds long. Extremely intense. For example, futures trading. 4. Position trading, long-term trades based on bigger trends. For example, spot trading. 5. Arbitrage, profiting from price differences across exchanges. Most beginners are drawn to day trading and scalping because they look exciting. But in reality, swing trading and position trading are far less stressful and more profitable for most people. Step 7: The tools pros use. If you want to trade like a pro, you need the right tools. TradingView for charting and technical analysis. Indicators: RC, Relative Strength Index, MACD, Moving Averages, Bollinger Bands. News feeds: Twitter, Cointelegraph, and community groups for staying ahead of events. Risk management tools: stop loss, take profit, and position size calculators. But here's the truth: no indicator will magically predict the future. They're just guides. The real edge comes from discipline and sticking to your plan. Step 8: The mindset shift. The most important lesson. Trading isn't about predicting the market. It's about managing yourself. If you can control your fear, your greed, and your impulses, you've already beaten 90% of traders. Think of it this way. Amateurs ask, how much can I make? Pros ask, how much can I lose, and can I survive it? Once you flip that mindset, you'll start trading like a professional. Step 9: Final word of caution. Now, I need to be crystal clear. Trading crypto is not for everyone. If you're just looking to grow wealth steadily, investing long-term, buying Bitcoin, Ethereum, or solid projects and holding them is a much safer strategy. Trading is a skill. It takes time, patience, practice, and emotional discipline. If you treat it like gambling, you'll lose. If you treat it like a business, you have a fighting chance. So let's recap. Crypto is profitable because it's volatile. Volatility creates opportunity, but also massive risk. Emotions drive markets, fear and greed create predictable patterns. Most traders fail because they lack strategy and discipline. With the right mindset, tools, and risk management, you can trade smarter, not harder.
Now that you understand the basics, the next step is simple. Learn, practice, and master your emotions. Because in the world of crypto, it's not the smartest trader who wins, it's the calmest. Thanks for watching, and I'll see you in the next video.